மார்க்கெட்டோட நிலவரம் மேல போகும் கீழே வரும். இந்த ட்ரெண்ட் எல்லாம் பார்த்து ஆசைப்படாதீங்க. கொஞ்சம் கொஞ்சமா நீங்க பண்ணுங்க இன்வெஸ்ட். கனவு எல்லாம் நினைவாக்குங்க, இதுதான் பெஸ்ட். ஸ்மார்ட் மற்றும் சிம்பிள் பிலாசபி. ஸ்மார்ட் மக்களுக்கு இதுதான் ஐடென்டிட்டி. டெஸ்ட் பண்ணு நீ, ஸ்டார்ட் பண்ணு நீ. சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான்ஸ் அண்ணா சொல்றத கேளுங்க. அண்ணா ஸ்மார்ட் ஆகுங்க. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. பண்ணனுமா 350cc சவாரி, இல்ல செகண்ட் ஹனிமூன்ல ஆப்பிரிக்கன் சஃபாரி. கட்டணுமா ட்ரீம் ஹோம் இன் டவுன் பேமெண்ட், இல்ல செக்யூர் பண்ணணுமா ராக்கிங் ரிட்டையர்மெண்ட். பிளான் பண்ணணுமா உங்க ஃபாரின் ட்ரிப். நான் செய்ய வேண்டியது ஸ்டார்ட் அ செப். ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயங்களுக்கு உட்பட்டவை. முதலீடு செய்யும் முன்பு திட்டம் சார்ந்த ஆவணங்களை கவனமாக படிக்கவும்.
Risks. Read all scheme-related documents carefully.
Good evening to all of you. Very happy to have you all this evening in the ICICI approved mutual fund and Hindu BusinessLine jointly hosted webinar. This webinar is going to deal with hybrid mutual funds. Typically in India, if you see, equity mutual funds are often in the news. Debt mutual funds are also often in the news for the right and the wrong reasons also sometimes. But hybrid mutual funds tend to fly under the radar often. This is unfortunate because this is a very interesting category in India because there are many opportunities to earn very good returns even from debt investments in the Indian context as in contrast to the developed markets. There are many 10-year periods in India where debt in fact beats even equity returns. Even from investing in high quality debt or gilts, you can actually make a very decent return. So this makes hybrid mutual funds a very interesting category. After the SEBI recategorization exercise, this category has actually become a very diverse one, spanning various types of products, right from the debt surrogate arbitrage funds all the way down to the aggressive hybrid funds, which are almost quasi-equity. So in the sessions that are going to follow, We are going to see very interesting discussions on this category that will hopefully inform you of all you wanted to know about hybrid mutual funds. So the first speaker today will be Mr. S. Harish, who is the South Head, Zonal Head for ICICI Approved Mutual Fund. He joined this fund house in 2012, but he has a 18-year stint in the BFSI industry, having previously worked with brands like Kotak, Cholamandalam, and Reliance. Mr. Harish is in charge of client acquisition and business expansion initiatives of ICICI Prudential Mutual Fund. His passions are mentoring youngsters to pursue a career in the BFSI industry and also grassroots development of the industry itself by convincing new investors to try out mutual funds as a vehicle. The other speaker we have today is Mr. Kaustubh Belapurkar from Morningstar. He is Director, Manager Research of Morningstar. Morningstar, as you all know, is the last word on fund research and ratings globally. And Mr. Belapurkar heads the Indian fund research operations. So his expertise lies in portfolio construction, mutual fund research, manager selection, and structuring investment solutions. So the first part of this presentation will be from Mr. Harish, who will take you through the foundations of the hybrid category itself. After a 20 or 25-minute presentation, we'll be going on to a Q&A between me and Mr. Belapurkar, where we will take key questions that you may have in your mind about this category. Thereafter, there'll be a short Q&A session. So over to Mr. Harish right now. Harish, on to you.
Harish is facing some technical difficulties.
Okay.
He will come back in a bit.
Yeah.
Yeah, I've done it. And I பேசுறது கேக்குதா?
Yes, it's clear. Yes, Mr. Harish, you can go on. So this presentation will take you through some of the key things you need to know about the hybrid category, because it has over 7 different types of funds today, and he will be briefing you on what each of these do, what are their functions, what is the portfolio role they fulfill, and so on and so forth.
He has actually dropped out, facing some technical difficulties. He should join back in a bit.
Should we can we go ahead with the Q&A first and then let Mr. Harish join in with the presentation?
I think he's joining. Just give a second.
இல்ல வீடியோ ஆடியோ ரெண்டுமே வர okay, I'll try to connect the data card and again re-log in now. Yeah, first கௌஸ்தபோட ஸ்டார்ட் பண்ண சொல்லுங்க.
Yeah, why don't we go ahead with the Q&A with Mr. Belapurkar first, and then we shall go on to Mr. Harish's presentation.
Yeah, we can do that.
Right. So, Kaustubh, actually, this is quite it's become a complicated category, because I remember 20 years ago, the only hybrid fund we knew was the balance fund, which was basically 60% equity and 40% debt. And then due to tax changes and various requirements that the industry itself perceived, the category has become quite a diverse and varied one. So first, let us discuss what is the portfolio role that some of the big kinds of hybrid funds actually perform. So if you take aggressive hybrid funds, for example, which used to be called balanced funds in those days. So what are the kinds of investors who should invest in them, and what is the time horizon that people should be looking at to actually invest in?
Sure. Hi, Aarti, and hello everyone. So I think it's very important to understand that asset allocation is a very important part of an investor's portfolio, and that's really the primary driver of returns. And that's where hybrid funds fit in so beautifully, in terms of providing that asset allocation. But I must put the caveat that, like you rightly said, it's a pretty diverse set.
Yeah.
And even within categories, there is certain categories which could have certain amount of dispensation about the broad range you can go at. But with that said, when you look at the aggressive hybrid category and the way SEBI's defined that clearly, it's about an equity exposure from 65 to 80%. So typically it's for an investor who's looking to take graded equity exposure. I would say minimum 5 years of sort of investment horizon is a prerequisite, because we all know that equities can be pretty volatile, and just COVID in March of this year has shown us that. And it's happened in the past. So I think that's very important to acknowledge that you need to have a minimum 5 year horizon, because you've seen multiple periods where markets have been flattish for extended periods of time. So I think that's the basic crux, that an investor who wants to take an equity exposure, perhaps a graded equity exposure, an aggressive allocation can be very suitable for a hybrid fund in that sense. But also, I think what's important to keep in mind that it's not necessarily a one size fits all, because every investor will have different risk return objectives, investment time horizon, or even from his own perspective, his or her own perspective, what is the allocation that's desired? If I have maybe a extremely long investment horizon, when I say extremely long, 10 years, 15 years, 20 years, I don't mind leaving that money untouched for that period of time. Then maybe even an 80% equity allocation might be on the lower side. You can potentially look at that. If I'm allowed to take on a little more risk, I can even go northwards of 80, 90%, depending on each investor's portfolio. But for a person who's looking minimum 5 years, probably investing in equities for the first time, or is still unsure of volatility, I think aggressive hybrid becomes a very interesting category, and for two reasons. One, obviously, because it contains the volatility, because you're taking graded exposure between 65 to 80. And I think behaviorally, I think is a very important thing in which investors should acknowledge. If I build a same portfolio of a debt fund and an equity fund separately in the same proportion, you can do that. No one's
Right.
But as an investor, as a new investor to the market, if I look at the equity fund, which has dropped 40%, 50% in sharp drawdowns, just looking at that product, I might panic and sell that. That allocation sort of aggressive hybrid category, it helps behaviorally attune me and say that, look, asset allocation is working for me, while my equity exposure might have fallen, but my debt exposure still remains kind of reasonably well protected in that sense. And B, what will happen is automatically the fund manager will rebalance your portfolio, like we saw in the month of April, where managers will add on greater equity exposure because the to bring back the exposure back. So I think it works beautifully in these ways for newer, slightly risk-averse investors who want to get into equities.
And it also saves you the tax implications of rebalancing on your own, right?
Absolutely. I think that's another very important thing to consider, is the tax implications, in terms of, obviously aggressive allocation funds do get a equity taxation.
Correct. The other thing is, where do the equity savings and the balanced advantage funds fit in? Actually, what kind of investors should go for these? Is it a person with a slightly lower risk profile than the aggressive hybrid investor? And is it also that, what is the time horizon that such people must be looking at?
Sure. So I think that's a great question, and because it's very important to understand what each of these categories do, right? So when you look at the balanced advantage category, which is again a very popular category in the investors, what the manager is trying to do is basically you want to have an equity exposure, which is a reasonably significant exposure. But at the same time, the manager, and typically most of the funds that would run are with a focus towards where the market valuations have gone. So a balanced advantage would dynamically change the equity allocation, depending on, if your markets become overheated, the valuations have become expensive, and, each manager would use slightly different metrics. But the broad mandate is that, when markets become overheated, you would want to sell out of equities and get into your less volatile asset classes, such as fixed income. And that's what balanced allocation funds let you do. But I think it's also important to acknowledge the kind of market scenarios that balance advantage funds can work beautifully, and that's typically extremely volatile sideways markets. But when you have secular bull runs, when markets are trending in a bull sort of market, it will become challenging for a balance advantage. And I think investors need to be cognizant of that. So I think balance advantage fits beautifully in the portfolio for an investor who's looking to hedge some part of his portfolio. But I wouldn't necessarily say that it should be the only fund in your portfolio which could meet all needs. So that's but it does play an important role in terms of kind of bringing down equity exposure when markets become overheated. The other one is slightly interesting, and I think the other thing also to note is that most balance advantage funds, and this could be a specific, an investor should check the fund they're looking into, would again try to look at managing, in terms of keeping the equity exposure at 65% of the long side, so that taxation again like an equity fund. That's also very important to note. The equity savings is actually very interesting because it's actually been sort of a way the product's been constructed where you bring in lower risk to the portfolio. So essentially what they would try to do is what we call net equity exposure. And I'll talk very quickly about what net equity exposure and how do they achieve it. They would keep that, and most funds in the category would tend to be in that 25 to 40% net equity exposure range. They would actually, what they would be doing is they would buy long, or they would buy equities greater than 65% again to be in that taxation bracket. But de facto, a part of that would actually be arbitrage opportunities, where, and I'll quickly talk about what arbitrage is.
Because that's also one of the hybrid categories, right?
Correct. Absolutely. So when you think about arbitrage, right? Arbitrage is basically you're buying something, say you buy a stock, and just for argument's sake, you're buying a stock at 100, and the same futures of that stock is available at say 105. And this is purely for an example's sake. You hold the stock and you sell the futures of that stock. So you're basically locking in that 5 rupee gain on that stock. The arbitrage is the opportunity that's called on the cash futures arbitrage. Because at the expiry of the futures, the price of the futures and the cash will, so irrespective of where the stock, the 100 could go to 120 or it could come down to 80, your 5 rupees in a sense is locked in. So it's kind of a, almost like quasi risk-free trade. And you will try to add yield to the portfolio by, these equity savings will add yield to the portfolio by investing in arbitrage opportunities. Unlike a balance advantage, which is not necessarily looking for yield, it is purely looking to hedge the net equity exposure of your portfolio. I think that's the primary difference when you look at it.
And also there's a slight dynamic element in the balanced advantage where you move according to market conditions. But in equity savings, you're keeping the part constant, right? The equity part, the net equity part. Right?
Yeah, it's at a lower band. Again, it could move, like I said.
Little bit.
That's right.
Yeah, right. So what are broadly the return expectations that investors should have from these hybrid categories? It's not necessary to deal with all 7, but broadly aggressive. From your experience of analyzing returns, what have you seen as the return possibilities in aggressive hybrid and conservative hybrid, as well as balanced advantage and equity savings funds?
So I think what's important is, when you look at these categories, right, we've obviously seen what past returns for the funds have been delivering, but it's important to acknowledge the times we live in right now. So, so I'd actually want to temper the expectations of the viewers a little bit that, we're obviously living in a lower interest rate environment, globally and in India. Even from the equity markets perspective, obviously, given the COVID crisis, things have been challenging around, the GDP, the earnings of companies, all of that. So I think that's the first thing I would want to acknowledge. And finally, the other thing we have to think about it is relative opportunities between what the investment options exist for you, right? So I spoke about lower interest rates that are prevalent in the country right now. You've seen interest rates across, be it your bank deposits, FDs, small savings, all of them kind of coming down, right? So relative to that, if you want to say take on some exposure, say in a conservative hybrid, where you're taking minimal exposure of 10 to 25%, depending on the fund and equities, you have at least a 3 to 5 year horizon. Something like conservative hybrid could add a little bit of, sort of delta to over a sort of fixed income portfolio, as long as you're willing to bear some risk over the short term, right? On the other end is, the aggressive hybrid, which obviously will be largely driven by where equity valuations and equity markets move. And that's why the longer you extend your horizon, your return expectations would smoothen out. And, if I just use examples from the past, even though that's no guide for what will happen in the future. A simple analysis of even, say, you look at your benchmark returns of the equity indices over the last 20, 25 years, the moment you start trending into the 5, 7, 10-year zone of holding, the volatility of your rolling returns comes down. So at any point of time you held it, you would have made with reasonable certainty a certain amount of return. And obviously, the chance of negative returns over that period significantly reduces as opposed to holding it for 1 3. So I think that return horizon becomes very, very important. But like I said, looking at past returns, what they've delivered, I think I would just temper the expectations.
Definitely.
I think that's very important to.
Yeah. And we should also factor in the high equity market valuations today. Therefore, not only debt returns, but on equity returns also, we need to temper our expectations.
Absolutely.
Right? Yes. So globally, this concept of target date portfolios has really been very catching on in a big way. In India, we don't specifically have target date funds. So is there any way in which hybrid funds can be used to construct target date portfolios?
Yeah, so that's a very interesting question, Aarti, and I think that's kind of food for thought for the industry also too.
Yeah,
that is definitely a solution which is very relevant, because now I think Indian investors are coming to that point where everyone is talking about how do I save for my retirement?
Yeah,
offer a goal. Everyone's, and I really applaud the investors that they've started thinking about a portfolio goal-based approach rather than simply a product, which is the best returning product over. Yeah. Now, I think the important thing, and just to lay the context of what a target date fund does, that suppose I as an investor have a retirement target, I want to retire in the next 20 years.
Yeah.
I'm sitting in the year 2020 today, and I want to retire 20 years down the line, which is 2040. I would buy a fund for my retirement, which is basically a target date of 2040. And the way the mechanics of that would work is it would start with a higher equity allocation. But as you go closer and closer to your target date of completion of the investment, the equity or the more volatile asset class would continue to keep reducing. And the less volatile or the more income producing asset class like fixed income, the proportion of that would keep increasing. That is in the what we call the glide path of the fund itself. The investor does not need to make any changes to his own fund holdings at all. You can do that through a hybrid fund, and that's why we have these various hybrid funds. But obviously, the investor, along with his or her advisor, using their prudence, would need to make the switches depending on the remaining time to their target sort of goal or retirement, as the case may be. So that's something that they'll have to kind of do that within their own asset allocation. It can definitely be done, but you just have to be a little more on top of things when it comes to that.
Right. This actually reminds me of the life cycle choices that the NPS offers. It has an auto choice where you start with a high equity exposure, and as age progresses, they keep cutting down the equity and adding to debt. And actually, they do it automatically without your having to intervene. So you're talking of something like that, right?
Yeah, absolutely. And just if I make one more point, which is very important, like you think when we start a journey of equity investing, and you say, okay, I have 10 years. I will go 80% into equities, or if I have 20 years, I'll probably go 90, 20, 100%. Maybe. But let's take an example of a client, say back in 2010, said that look, maybe Jan 2010 or Feb 2010 said, look, I have a 10-year horizon. Let me put a bulk of my money to equities, and he remained on that static equity allocation. Come March, he might have actually reached it in Feb, but he would have seen a significant drawdown. So a target date fund or rebalancing towards a less volatile asset class would have taken care of his goal rather than staying invested in the board, because the event risk can be huge as you approach your the target date of your portfolio.
Right. In India, we have this peculiar practice of investors relying on hybrid funds for regular income, and in fact, monthly dividend plans of these funds were quite popular a couple of years ago, and I've known many investors even in Chennai who basically moved from FDs to these funds. So are hybrid funds a suitable vehicle for regular income? Are aggressive hybrid funds particularly a suitable vehicle, or should investors be looking at something else within this category? So what are your thoughts on that?
Sure. And I think that's a very important question at the end. We've been pretty vocal at this thing about that. An aggressive hybrid fund. And you have to think about, when you think about dividend, right? I mean, a mutual fund dividend, it's very different from what a stock dividend is. So I think that's the first thing investors need to acknowledge, that, a stock or a company is actually paying out profits that is generated, from its cash flows, it's actually paying out those sort of dividends that are available to the shareholders. But in a mutual fund, it's slightly different, right? And that's where we need to break down what are the components of how does a mutual fund generate profits, or rather returns for its investors, right? Especially in the context of an aggressive hybrid fund. So you'll have your debt component, which is it's earning coupon monthly, whatever, quarterly, half yearly, annually, or whatever, which is kind of your fixed coupon that comes in depending on the investments that you made. But the equity portion, right, is really dependent on the movement of the markets, because if the markets have been down, you're not really getting any capital gains per se. Now that's where it becomes the problem that, and I think SEBI is also kind of recognized that to make the right information available to investors, they've actually asked these dividend options to be renamed in terms of income distribution and also some
recently.
Yeah, that's right. So I think that's very important to acknowledge that it could be potentially the case that you're just getting a part of your capital back. So that's where maybe an aggressive hybrid fund. So that's one. That's obviously one of the things. The other thing is if you're expecting a regular certain amount of dividend for the reasons that I just explained, because an aggressive hybrid fund would have northwards of 65% in equities, it's not necessary that it'll always have that distributable surplus to pay out. And that's, I think, so to rely on that for a continuous dividend is a little bit of a challenge.
Yeah.
And third, obviously, taxation, which has also become a very important angle
Yeah.
in budget announcements of dividends being taxable in the hands of the investor.
Right.
If you're falling into the higher tax brackets, clearly you would want to look at, and again, I would urge everyone to talk to their CAs or the financial planners, but just intuitively, a capital gains tax would make more sense rather than being invested in a dividend plan. Yes, if you do want regular dividends, if you look at the slightly less riskier parts of the hybrid funds, would probably make more sense, exactly for the reasons I explained, that if you have a larger fixed income allocation, you're generating that coupon, which you can potentially pay out. I think that would make more sense from an investor's perspective.
Yeah, perhaps conservative hybrid funds or equity savings are better vehicles for savings.
That's right.
The other thing is not relying on the dividend plans at all, but going for the systematic withdrawal plan route, which many retirees also do for its tax efficiency, right? So how does that work? I think that will be useful to viewers if we talk about it a bit.
Yeah. So again, I think, similar sort of thought process, right? Because the less aggressive or the conservative sort of plans, I think beautiful options to think of for SWP. The other problem is with something that is linked to the market. When you're withdrawing an X number of rupees or 1,000 of rupees every month, the moment your NAV falls quite significantly, you're actually selling down at lower levels.
Correct.
So I think that's something which investors need to be cognizant of. I think a beautiful way of doing that is if you can actually service that through a debt fund or a conservative hybrid fund.
Yeah.
And if you still have, and it truly depends on each person's financial position, can he allocate some growth capital to an aggressive hybrid or an equity fund, which he doesn't really touch or doesn't, need that for the time being. He can generate his income monthly requirements through a more conservative option, and the rest of the capital can actually go into an equity or an aggressive hybrid fund, which stays as is and actually grows towards a sort of greater pie for him, which he can use down the road.
So basically, you don't withdraw from that aggressive hybrid fund. You just have it to contribute the growth component of your portfolio.
Absolutely.
And you use the debt fund or a conservative hybrid for your SWP, for your cash flows, right? That's what you're saying.
Yeah.
Yes, that's a very good strategy. Yes. So while selecting aggressive hybrid funds, which used to be balanced funds, what are the things to keep in mind? Because I've also seen that though there's a broad category called aggressive hybrid, there are great differences in the way individual fund houses manage their equity and debt portions, right?
Yes,
So what are the 3 or 4 things that investors need to keep in mind while choosing these aggressive hybrid funds?
Sure. Okay. So that's again a very important point that you raise, Aarti, that while it's a category which funds are clubbed together, there are inherent differences, and I'll just bring out some of the things that investors need to look. So when you look at, one is obviously the equity exposure typically that fund would hold. The band, like I said, is 65 to 80%. Some would probably be hugging the 65% band. Some would be upwards of 70, 75. So that's the first question that an investor needs to look at. And not only what is it being managed today, but traditionally, how has it been?
Yeah.
I think that's very important that, has that manager kind of stayed within a particular band or not, because that will give you comfort when you're trying to do your own asset allocation through the strategy, which one really fits the sort of bill from your perspective. That's one on the equity side. The other thing you need to look at is not just that, and there's a very beautiful tool that a lot of people publish. It's called the style box, both an equity and a fixed income style box. I'll very quickly talk about that from the context of where does the unlike equity investment happen? Is it in large caps, mid cap, or small caps? Because we all know that volatility varies for these, and managers will use different kinds of. There would probably be a large cap bias manager. There could be a more multi-capish manager. Now, again, I think investors need to, depending on their horizon, their risk appetite, do I want to buy a pure large cap sort of equity portfolio within this this thing, or can I go down the capitalization curve where potential long-term returns could be better, but interim volatility can be much higher, as we've seen over the last so many years, right? That's really one on the equity side. Again, I would tend to look at how historically has that been managed within the same band, which gives me a confidence that yes, what I'm getting into, it'll be the same or broadly the same, even 2, 3, 4 years down the line in terms of the management. The second, again, very important thing is on the fixed income side. One is on the interest rate risk, which we all know that, there's duration, and we have seen that, funds have done really well as the interest rates have come down. But, there could be scenarios where either interest rates are flat or they start going up.
Yeah.
And, funds that are running higher modified duration or the maculate duration are being published, you can see it in the fact sheets, will tell you that there is higher interest rate risk embedded in that. Obviously, it's on a smaller part of the portfolio, but it still exists.
Yeah.
The other part is more important, which is the credit risk. Which
do funds actually take credit risk on their balance funds also, hybrid funds?
Yeah, so if you look at, if you just look at the history and what currently they're holding, you would have funds that would have, some AA pluses exposure. Certain funds even having a little bit of single A. It could either be something that they invested into or bonds that got downgraded into those credit buckets. I think that's the other important question that investors need to ask, because obviously a fund that's going down the credit ladder would give you additional yield. But are you comfortable as an investor taking on that little bit of element of credit risk, or would you prefer a fund that largely invests into the AAA, AA plus sort of buckets? I think that's the other bit of assessment that an investor should do, because it's important, because that will really help you bring out that, okay, this fund has traditionally done better, but these are the reasons why probably it did better, because maybe they took on some of the high yielding credits or took on some other risks that you need to be cognizant before you invest.
Right. The other big question for investors looking to invest in the hybrid category are the high expense ratios in this category. So actually, having done some analysis, I've found that typical TERs are 2% or upwards for many. And even for equity savings and conservative hybrids, they tend to be upwards of 1.5%. Now, this can take quite a bite out of the returns, because as you said, return expectations also need to be tempered from here on, given that basically we are going to see lower debt and equity returns. So what are the typical benchmarks that investors should look at in terms of TERs while selecting schemes? What is very expensive and what is reasonable in your?
Okay, sure. So the first thing you should be doing as an investor is, and I think the cost argument is very important, but it shouldn't be taken in the wrong context. And let me just elaborate what I'm saying. That when you're doing your analysis, the cost should be a factor, but it shouldn't be the first determining factor when you're trying to shortlist funds.
Okay.
And the reason why that is because if you're choosing cost as your first filter to pick a fund, you potentially are just picking funds which are probably inappropriate, from your own perspective. So rather, what you should, as an investor, be doing is look at what are the suitable options, make a shortlist of the funds, and then if everything else being the same, which are the cheaper options available within that.
Right.
And I think that's what you should do. As a benchmark, again, because it's obviously we know globally, the expenses can be, different from what they're in India.
Yeah.
As an Indian investor, you have options within the Indian space. Things like, is it around the average of the peer group? After you've done all of this analysis, would help you understand how cheap or expensive a fund is. But like I said, it should be kind of the end part of your filtering criteria rather than the starting point to your analysis, because you should always first choose what is the fund that's suitable to you, and then think about which are the cheaper options within that. And I think the same argument, and people have spoken about the direct versus regular, and I think that's very important, is that if you as an investor can't make those decisions and you're using someone to help you make those decisions.
Right.
So don't just purely use direct by yourself and make a wrong decision because that fund is cheaper. Exactly the
Right.
same point.
Right.
I think that's something, again, investors should definitely keep in mind. It's great that direct plans exist, but it's important that investors who have the wherewithal understand what they're getting into, get into that. Otherwise, please use the services of a financial planner, advisor, whoever can help you do that, because the last thing you want is to get into a wildly inappropriate fund, which will actually do more harm than good purely for on the cost basis.
Essentially, fund selection is far more important than the TER. So if the fund selection goes wrong, no amount of choosing the lowest cost fund is going to help you. That's what you're saying, right?
Yeah, absolutely.
Yeah.
I mean, costs are an important factor, but not
the first filter you should use.
Absolutely.
Yes. And also, since performance is net of cost, so the NAV does capture costs already. So you are actually looking at returns net of cost. So a final question before we go on to Harish, which is about this taxation of hybrid funds, right? So the debt, there is a wide variety of taxation, right? Debt fund hybrids, debt-oriented hybrids are taxed differently, equity savings differently. So briefly, can you run through this taxation?
Yeah. Sure. So when you look at the taxation, right, and again, I'll give the caveat that I'm not an expert in taxation. Every individual's tax treatment. I mean, in terms of
tax slab.
Slabs could be different, but when you look at simply what the tax slabs say for equity, right? So you have capital gains. We already established at the start that dividend now is taxable in the hands of the investor. While there's a TDS that is deducted above a certain amount, but basically, the rest, and that's why dividend has become kind of unattractive because, if you're in the higher tax brackets, it makes sense to go to capital gains. Now, capital gains, when you look at it, you have short-term capital gains, which is for a period of 1 year at 15% for equities, and 10% above an amount of 1 lakh after a year's holding. So obviously investors will need to do that bit of math when they, kind of book in and out of the equity funds. On the debt funds, again, dividends like we've already spoken about. But when you look at the capital gains taxation, right? So the short-term capital gains is again at the, where the investor's tax rate lies. So I think that's very important. The long-term capital gains is actually a very interesting concept where it's 20%, and remember, long-term capital gains for debt is after 3 years, unlike equities, which is after 1 year.
Right.
Is actually at 20% with the concept of indexation.
Right.
So indexation, basically, what it tells you is that there's a concept of index cost of purchase. So if you bought something at 100 and you held it for a period of 3 years, your cost price will not be 100, but rather it could be, maybe 110, 115, depending on what the index cost, which is published. You can pay tax only on the difference between what you're selling it at, the end sort of NAV versus the index cost, that at 20%. So I think that's very important for investors to keep in mind. But like I said, please consult your CAs and tax advisors when you're actually making those decisions.
Thank you so much, Kaustubh. That was a very illuminating and precise set of replies to these questions. So I see a lot of interesting questions from the viewers, but let us now go over to Harish, who's ready with his presentation. And after his presentation, we'll again go back to Q&A. Kaustubh, please remain with us so that we can come back to you at the Q&A session.
Sure. Thanks, Arti.
Yeah, welcome, Harish. Please carry on.
Yeah, thank you. Warm welcome from ICICI Prudential Mutual Fund. Sorry for the technical glitch. So we'll just straight away move on to a presentation. The next slide, please. Basically, this is the biggest advantage what we have in the mutual fund industry. It's completely a professional managed, low cost, relatively low cost, high liquidity, diversification, transparency. Whatever you ask, almost everything is there. So a very well regulated industry, which is growing fast. So, I'll just cover some more data points down the line, why people can look at mutual fund investments as a core on the overall portfolio. Next. This is the classification of mutual funds. Basically, the three broad categories. which is equities for the wealth creation, debt for the saving solution, and hybrid basically, which would be balancing both equity and debt. As today's topic is on hybrid, we'll just see some more data in detail down the line. Next. So if you just look at the asset allocation perspective, what Kaustubh also spoke. So you need to have a combination of equity, debt, and gold. So a lot of people because the industry AUM, that is at least from the retail perspective, individual investor perspective, a lot of people are thinking investments in mutual fund means it's pure equity. It's not only equity, debt is there, gold is there, this particular hybrid is there, which will really help in doing the overall asset allocation. Next. Equity, basically, as you all know, this has been invested, which is having a high potential to give a very good capital appreciation. The debt in the portfolio, which will give a good accrual returns, and gold will act as a hedge in the portfolio. Next. Yeah. So in equity, as you all know, once just either you go and buy an equity portfolio through mutual fund or a stock, basically you're just becoming a part of an owner, and minimizes the risk, and relatively minimizes the risk, the equity mutual fund portfolio, when compared to one individual stock. And you have a better tax advantage, as well as a good wealth creation happens, and you have a good liquidity in the mutual fund portfolios. Next. Yeah. So equity wealth creation, as I spoke, since 1979, when the Sensex got incorporated, if someone could have invested ₹1,00,000, today it's around 3.8 crores. This number 3.8 crores looks so big, but actually, if you just look at the CAGR, it's close to around 16%. CAGR is around 16%. So I'm not saying that in future you're going to get that, but the point what we are trying to communicate is in the last about 40 years, okay, whatever need to happen for this country has happened. So you take an India-Pakistan war has happened, so many prime ministers have come, so many policies has changed. Irrespective of all these things, okay, the equities have performed well over a period of time. Okay, equity is showing so much of returns. Do I need to go and put all my money into equity one shot? No. So we'll see. That's where this hybrid funds is going to help the investors how they can minimize the risk and get a decent returns. Next. Fixed income, basically the debt. What happens in debt is on a relative basis when compared to equity, it is relatively less volatile. It gives relatively good regular cash flow. There are products which can give relatively a good regular cash flow, and flexible investment time horizon is there, starting from 1 day to any number of years. Even people can invest for 1 day, 7 days, 10 days. From very, very short time frame to very long term of 15, 20, 30 years also. Next. As I just showed in the earlier slide, the overall equity performance over a period of time, here just one of the index which I've showed here is a CRISIL composite bond index. If you just look at the up to 15 years, starting from 3 years to 15 years, the CAGR returns is somewhere around close to 9%, which is 8.8 plus. So the broadly what happens is the fund manager tries to beat the benchmark of the relative index. So if the index return is so much, then you can just imagine what can be the returns of the debt-oriented products. Next. Yeah. Gold performance, as you all know, gold is a hedging asset class. Gold is also a component in the hybrid category, in one of the category, which I'll just speak later. Next. So generally, if you just look at it, the Indian household savings, close to 96% of the financial savings are into the traditional investments, like your deposits, currency, insurance, provident funds and retirement funds, government instruments. Less than 3.5%, and again repeating, less than 3.5% of the financial savings are there into shares, bonds, and mutual funds. So just we have seen what is the kind of returns an equity or relatively a bond index has delivered. So if this is a case, okay, 96% of the wealth is sitting into the traditional investments. So that's the reason, customer as an investor, rather they taking a call into a pure equity or a pure debt, okay, hybrid will become so handy for them to manage both equity and debt. Why and so on, I'll just come to it later. Next. Why more compelling reason to look at mutual fund? This is more a compelling reason to look at mutual fund. And within the mutual fund, why hybrid will play a critical role? This is an answer for that. We just look at the current interest rate regime all across, starting from fixed deposits to all the the government schemes. It's there in the range of somewhere between 5.5 to maximum around 7.5% kind of returns. And you can just see what is the kind of interest rates which has declined in the last about 1.5 years. Next. So next is about the deposit rates. Each of you know what is the current deposit rates. Next. Deposit rates are also declining. So that's all these things gives a compelling reason for the customers to look at mutual funds. As I just told, we have equity, debt, and hybrid. We'll see hybrid in detail now. Next. What is hybrid funds? Next. So basically, hybrid funds is a mix of equity and debt in different propositions. In certain products, there is a gold is also part of the respective portfolio. Next. Basically, equity means you can just think of Virendra Sehwag's innings. Okay, he comes, hits sixes and fours. So equity is like that. Okay, and debt is like Rahul Dravid. So more predictable, very, very defensive. So that's how I'm just trying to correlate with cricket and the investments in equity and debt. Equity and debt is like this. So debt is basically more conservative, relatively defensive, and so on. So that's the reason I'm just using this example of Rahul Dravid. So he's more predictable. If he comes, he plays. See, he's more predictable. So Mr. Sehwag is a good player, but he's like an equity investment. He comes, either he hits or he goes out. So that's how the equity and debt in parlance which works. Next. So the hybrid strategy, so rather putting the entire money into pure equity or pure debt, this hybrid strategy will help for effective portfolio rebalancing. That's the reason we are saying that hybrid has to be one of the core allocation in any customer portfolio. Next. Next. Yeah, this is a key slide. This is a very, very key slide. If you just look at this, we have plotted the SEBI categorization within the hybrid funds. We have just plotted the SEBI categorization within the hybrid funds. There are about 7 subcategories. The first is about conservative hybrid. I would not go in detail about each and every category. I'll just give a glimpse. The conservative hybrid, basically, which will have a 10 to 20% equity, predominantly into debt, which is around 75 to 90% will be debt instruments. That 10 to 20% equity risk you are taking, to that extent, you will get a relatively better of return. Next is about the hybrid. So just go back. Yeah. The second category is balanced hybrid. In this balanced hybrid, basically the equity debt instruments can be in the range of 40 to 60, both equity as well as debt. Both would be there in the range of 40 to 60. The third category is aggressive hybrid. In this, minimum will be 65% of equity, maximum can be 80%. Then the fourth is an interesting category, the dynamic asset allocation category, or it is called a balance advantage category, where it can be there in the range of 0 to 100% equity or 0 to 100% debt. It's completely the flexibility of the fund manager where he can take a call. But each and every product in different fund houses will have their own internal matrix and so on. But it is having a flexibility to move from 0 to 100 equity and 0 to 100 debt as per the SEBI categorization. The next category is a multi-asset category. As I just told, in this you can have equity, debt, gold, as well as some of the commodities also. But only this one is at any point in time, each and every category need to have minimum 10%. Now, if it is gold, it has to be 10%. If you're choosing equity, it has to be 10%. If you're choosing debt, it has to be 10%. So all the three asset class need to have minimum 10%. This is the multi-asset category. Then you have an arbitrage fund and equity savings fund. Arbitrage is tend to be more of an HNI and M&A kind of a product, and equity savings. So the equity savings fund, which is basically minimum, the equity and equity related instruments has to be at 65%, debt has to be 10, and the derivative instruments based on the scheme to scheme, it will change. So there are products with 40% equity, 50% equity, and 60% equity. So it depends. It varies from scheme to scheme. Yeah, next. Why hybrid funds? So basically, this is the one more interesting slide. Why investors should look at hybrid funds managed by the AMCs or the mutual funds. The reason is this: if you just look at the first tabular column, which gives the Sensex returns since 2006 to 2019. Every year it is not linear line. Every year it is not a linear line. So 2006, Sensex has delivered a 46% returns. 2008, it has delivered a minus 52%. 2011, minus 24. In 2014, 29%. 2017, 28%. So as I just told, equity, it will be volatile. Yes, it is volatile. Every year, there is a clear, if you just look at the color code, either it is red, yellow, or green. Same with respect to debt also. Debt has not given negative returns with respect to the short-term bond index, but still the returns at times it is muted. When it goes to gold also, yes, gold also has given negative returns, as well as it is there in yellow zone, which is a moderate return, green zone, which is a good return when compared to the three asset class. If you just look at 2011, equity has delivered minus 24%. CRISIL bond index has given a 7.9, and gold has given a 10%. So at least one of the asset class has given a better of return. So this is the reason any investor will not be able to go exactly predict that this year equity is going to give return, I'm going to put money into equity. Or say, for example, you take the case of 2016, look at the short-term bond index, which is a debt. Okay, this year bond funds are going to give 10% return. I'm going to put the entire money into bond fund. Or it is not like a last year 2019 where gold is going to give a 25% returns on 1st January. I'll just go and put the entire money into gold. So that can't happen. No one will be able to time exactly the market. So this is how, this is why the hybrid funds are very, very important based on the views of the market on all the sides. Either it is equity, either it's a bond market, or is the interest rate, as well as the gold views. So based on this, fund manager takes a call. Not fund manager in the sense is not only one single person. As a process, every MC have their own set of team to analyze, predict, take views on all the asset class. Based on that, this hybrid allocation happens. Next. The hybrid allocation happens. This is how the hybrid allocation happens. As I just gave different matrix to different products, like in one of the product I said it can be 0 to 100. In other product within the hybrid, I just told minimum can be 75 to 90% debt, or 25 to 10 to 25% has to be equity. How all these happens is, okay, the rebalancing happens depending upon the product. The rebalancing happens between equity and debt on a regular basis. So basically, certain products works like this. Whenever the equity valuation is up, okay, which is the equity valuation is high, that is a time a lot of retail customers come and put in money. Actually, it starts to be the other way around. where when the valuation is high, you need to sell equity, reduce the exposure, and keep cash. On the other end, when the market falls, you need to have cash to go and buy equities. So this is how the buy low, sell high theme works. This is being practiced in a lot of schemes in this hybrid category. That's the beauty of giving the money to an AMC, to the fund house, to the fund manager, helps in terms of managing this hybrid category in a better fashion. Next. Yeah. Here, what we have just done is slightly technical. I'll just try to explain this to you. The first tabular column is 100% pure debt. Is a pure 100% pure debt. On the left-hand side, we have plotted risk and return. On the right-hand side, we have just plotted the risk-adjusted returns. If you just look at this, the first tabular column, which is 100% debt, in this, the red color bar, you are just taking a 2.5% risk. You are generating a 6% return. On the last tabular column, okay, the last bar graph, we just look at this. It is 100% equity, which is you are taking a risk. You are taking a risk of around 14% risk. It's a crude way I'm just putting it across because risk-adjusted return itself is a concept. If you're just taking a 14% risk, you are getting close to 18% returns. But that return, as I just told, if it is a pure equity, it is volatile, as I showed the example of Sensex returns itself. We have just plotted the one tabular column, the one portion of this particular bar graph in the blue color zone. If you just look at it, that is a better risk-adjusted return, where 90% debt, 10% equity, or 70% debt, 25% equity, and so on. This particular, the second, third, fourth, and fifth bar graph, we just look at this. You are just taking relatively a minimum risk, and you are getting a moderate returns. This is what the customer wants in general: relatively less volatile, more of a predictable kind of return. So this is what the hybrid funds gives in the overall portfolio. This is how the hybrid funds behaves in the overall portfolio. So hybrid funds gives a better risk-adjusted returns. So you just take a relatively less risk and relatively a moderate returns also. Let us see some of the hybrid funds, how it has delivered returns and so on. So next. Yeah, next. Yeah. So a lot of people now think that when they come into the markets or when they come and invest into the mutual fund, they say that I'm going to be a long-term investor. I just want this XYZ ABC kind of a percentage kind of returns. But actually, let's see how the investor behavior is. Can you just go back to the previous slide? Yeah. So what happens is on the peak of the market, some of the friends will come and say this: you buy this stock, you buy this fund, and so on. So that greed, out of greed, people will just go and buy, or they go and put money on the peak of the markets. At the same time, what happens is they go and sell on the bottom of the market because of fear, stating that, okay, the markets might further come down. So this is an investor behavior. So let us see some of the graph, how the investor thinks his returns has to be also. Next. Yeah, this is what, just go back to the previous slide, please. Yeah. So this is what, customer wants. Okay. If someone invests 1,000 rupees, assuming that he wanted to have a 12% returns, okay, the first year he wants to exactly have this, on 1,000 rupees, 120 rupees as a appreciation, which is a 12% returns. So they wanted to have a very, very steady kind of returns, like what it happens in the fixed deposit when they come and put money into mutual fund. Actually, it doesn't work like that. Next. So if you just look at the expectation of the customer, they wanted to have a year-on-year 12% returns. On the right-hand side, this is the reality when it comes to investments into market-related investments, which is a mutual fund. When they come here, what happens is the first year can be 8%, the second year can be minus 14%, the third year can be positive 48%. At the end of the fifth year, the average return, the expected return can be there in the range of 12%. Okay, the average return can be 12%, but this 12%, this number, this is only for illustrative purpose. It can be 8%, 10%, 12%, any number, but this returns will come with the volatility. And one more issue, the next slide will show to you. The next slide. Yeah, what happens is at the second year, when they see a minus 14% returns, lot of customers move out of the market. As I just showed a couple of slides back, they come on the peak of the market and the bottom of the market, or when the market is highly volatile. What happens is when portfolio shows a negative return, they come redeem the money. So assuming that in this illustration, if it is 8% is a first year return, second year return is minus 14%, they go pull out the money and go back to their traditional investments. So any of the traditional investments which can give a fixed return. So in this case, in this illustration, there is a third, fourth and fifth year customer is getting that 7% return, means the average return for him is 2.6. He'll be an unhappy customer. And what happens is after investing into this market related investments, they think that because of this, I'm not able to make returns. But the fact of the matter is over a period of time, either they are going to be there in equity or in debt or in especially in this kind of hybrid products, over a period of time, if they're going to be there, definitely they can make a relatively decent returns. That is what the past history shows. Next. Yeah, this is again an interesting slide. Just want your minute of your attention on this. As I just showed different products, to you, okay, different categories which is there in the hybrid fund. We have plotted the different hybrid index performance. As I just told, okay, in this index performance, we have plotted a 3-year, 5-year, 7-year and 10-year returns. If you just look at the first one, the CRISIL hybrid 85 plus 15 conservative index. So don't get confused about this names and all. There are products which is getting benchmarked against these respective index. Just focus on the percentage of returns generated by these index. If you just look at this particular index, if you just look at the first index, okay, on a 3-year basis, it has delivered about 8% plus across time frame. This CRISIL hybrid 85 plus 15 conservative index, across time frame, it has delivered returns in the range of 8 to 10%. We just go to Nifty TRI, which is the last one, which is basically which is being compared with a lot of products on the equity side, pure equity. Okay, there if you just look at it, somewhere between 3 years to 10-year returns are plotted. It is there in the range of around 6.5 to 10 years, 10%, 6.5 to 10%. So what happens is the right hand side, you have pure equity. Rest of the 4 different index are basically a different hybrid index which is there. If you just look at this particular hybrid index, broadly all the index, the returns are there in the range of, except for the third one, where it's showing about 7%. Yeah, even if you just take that 7%, so somewhere between 7 to 10% is a kind of returns generated by these hybrid index. So now the important factor is the fund manager need to generate alpha over these index. So that's the objective of the fund manager. The objective of the fund manager is to generate alpha over this. So any of the hybrid products you are going to choose, as I just told, this is number one, relatively conservative, and second thing, with this kind of a mechanism of buy low, sell high, increasing debt, increasing equity at the appropriate time, or increasing exposure into the gold, fund manager takes all the call. He manages the money and ensure that on a relative basis, he'll try to do his best to beat the respective benchmark. So this is how this entire hybrid scheme performance works, or this is how the hybrid funds are being benchmarked against different indices. Next. Yeah, the benefits of hybrid funds. These are the benefits of hybrid funds. It manages cyclicality. The important thing, as I just showed it to you, we do not know as a common man this year whether equity is going to deliver best returns, debt is going to deliver best returns, or the gold is going to deliver best returns, fund manager takes care of the cyclicality. He takes a call on the markets, on the respective both on equity and debt markets. He manages the money accordingly. Second thing is benefit from volatility. As I just showed, lot of this asset allocation funds which works on a buy low sell high strategy, which will relatively benefit from the volatility. It is not necessary that every time the returns are made only by buy low and sell high. Actually, the returns can be made when you protect the downside also. In the markets, there are two ways of making returns. You buy low, you just go sell it at the higher price, you make one X return. The same time, you have invested in a set of either a stock or a bond, where when the market is going down, your stock or a bond, if it is not going down, you're protecting your downside. That is also one way of making returns. So this particular asset allocation schemes or a category which is benefiting from this volatility gives that kind of returns. That is also alpha to the portfolio. Third is about managing the investor behavior. As I just showed the illustration with respect to returns, being there in the hybrid fund, relatively the volatility will be relatively less, so that the investor behavior also can be managed. As I just told, this is being thoroughly professionally managed. So, give it to the fund manager. He will take a call what to be done between equity, debt, and gold. Next. To summarize, investor decision-making process may be clouded by a lot of sentiments, greed, fear, friends calling, channels speaking about, different views and so on. Here, by coming into the hybrid category, it is the discretion of the fund manager. He'll take care of everything. And diversification of the asset classes also, which happens. And the prime most important thing is different asset class, as I just told, has a different cycles. Based on the cycle, it is being well managed. So overall, for a better or a good asset allocation or a prudent asset allocation, hybrid funds plays a critical role. So to benefit this, I would urge investors to look at hybrid funds also part of the core portfolio, apart from pure equity and pure debt, which will relatively help to reach their investment goals. So that's all from my side. Thank you, BusinessLine, for the opportunity.
Thank you so
over
much.
to Aarti. Yeah.
Thank you so much, Harish, for that detailed presentation, especially the numbers showing how hybrid funds in different categories help smooth out your investment journey and help you avoid these emotional ups and downs which actually wreck your investment plans, right?
Yeah.
So now we'll be running just a few compliance slides, and after that we will go on to the Q&A, where I see a lot of questions lined up. So these are just some basics that you need to take care of while investing in funds. It's about nomination. I mean, you may make the most fantastic investments, but if you don't have your nominations in place, then your heirs will not actually get their hands on your investment. KYC is not something we all enjoy, but it's a necessary evil when you want to invest in financial products. Right. Let's go on to the question and answer sessions now. So the first question is from right. So we are done with the compliance slides. So the first question is from Mr. Narendran, who is asking, is it a good idea for investors to do their own asset allocation rather than go with hybrid funds? I think we touched upon this briefly, Kaustuv, but could you answer this question?
Sure, sure. So I think, and I think that's an important question to address because you can achieve the same objective through either of these options, and it's really about how much time can an investor spend on building his own portfolio, or does he want to use the services of a professional advisor doing that, or does he want to go into a de facto option of kind of something that gets him both the options through one single product option. So it really lies on each or his or her preference in terms of investor. I think both are prudent ways of doing it. Obviously, you need to keep certain things in mind that your overall asset allocation should be either matched through a hybrid or the underlying funds. But like I said, for newer investors, and even Haresh touched upon it. Emotionally, when you think about a particular fund or a particular asset class, especially like equities correcting significantly, like we've seen more recently this year, it can have an impact about them actually irrationally redeeming from that. Hybrid funds takes care of that, that emotional aspect of investing, and obviously you have a professional manager who would then kind of tweak, rebalance a portfolio. That becomes important. So either way is fine, depending on the level of engagement an investor can do, or does he want the more sort of de facto convenient route through a hybrid fund. Both are good. Obviously, you keep taxation and other things in mind also when you make those decisions.
Right. So when you make the allocation yourself, you will have to keep pretty close tabs on both the debt and equity markets, right? Which is quite a tough task for the investor.
Yeah, I would say typically it's like you build a static sort of allocation to start with, but as each moves, right? Again, classic case. If I was an equity investor, markets had run up prior to the crash in March, I would have started selling off some of my equity and going back into debt towards my intended allocation. Now that would have happened directly, maybe through a hybrid fund, but if I'm doing it separately, I might need to do some of that myself.
Yeah.
So I would have protected some part of my portfolio in the fall, and at the same time, I would have rejected back to the strategic level the moment the market sort of corrected and I could buy equities at lower levels.
Right. Harish,
one more point. I just want to add one more point. Issue is when they just go, assuming that they put some money into a pure equity fund. Okay, if that particular theme or a category runs up, okay, there is an exit load issue which is there. Assuming that they are, within the 1 year they wanted to remove, exit load is there, and taxation is there. Very, very important is that taxation is there.
Correct.
Okay, if it is being done by the fund manager within the fund, okay, that taxation part, say assuming that if it is short-term or long-term capital gain which has to be done, so that is being well managed at the overall portfolio level. So that is also one of the benefit of giving to the professionals to manage.
Right. There's one question from Ishan who says, very provocative. It says, if asset allocation is so powerful, why have these funds started performing only recently? So let me start by saying that they have not started performing recently. If you actually look at the 10-year returns for hybrid funds, they are better than the 5 and 3-year returns. Am I right, Kaustuv, in saying this?
Yeah, absolutely, Aarti. I think, the case for asset allocation just gets stronger and stronger by the day. And this is something that is practiced globally. And I think it's very important for Indian investors to acknowledge that it's not only about equity or only about fixed income, things like gold. It didn't go anywhere for so many years.
That's right.
decade. And suddenly you had this huge run up. Now, the problem to me is that ideally you should have been holding it as a strategic allocation back then rather than trying to buy it now. What asset allocation will help you do? I think that's something that's very important to acknowledge.
Yeah, Haresh, you have something to add to
this? No. In fact, that is, I've just put it on the slide also.
Yes.
How the hybrid bars are looking at and how the equity at this one. So,
Right. So Anand Bala had two questions. So one was, at what level of India VIX should you move from equity to debt? It was addressed to Haresh, but are you willing to answer it or shall I go ahead?
Sorry, can you just get the
At
question?
what level of India VIX should you be moving from equity to debt?
Levels, being an education program, will not be able to speak about the levels. So
see, broadly, I feel India VIX is not the only factor you should be looking at, though it's the fear gauge, and generally at levels of below 20, it indicates a high degree of complacency in the market. But we would not actually recommend you look only at India VIX to determine your asset allocation. As we've been saying in this program, asset allocation is a very personal decision. Also, it has to be customized to your risk profile, your goals, your ability to take downside, etc. So these behavioral indicators can be a little help in knowing whether an asset class is overheated, but I don't think they are the only thing you should be looking at.
Yes, yeah.
Yeah. So another question that Anand Bala has raised is, if we are at the bottom of the interest rate cycle, what kind of returns can we expect from debt? Harish, would you like to take this?
See, we can't put a number at this point in time, but as I just showed, the 10-year CRISIL bond index or a CRISIL short-term bond index returns, okay, the 10-year cycle of any of these things, and I'm not even looking at the short-term, on a 10-year, 15-year cycle, I just showed it in the graph. No, it has, if you're going to be stay put invested on one cycle of the interest rate cycle, like an equity cycle, if you're going to stay put invested on a one complete cycle of the interest rate cycle, I don't think so, even if you're entering in the relatively low interest rate regime, you would definitely not make a very bad returns. Okay. Plus important thing, you being, customers being at a 20 and 30% tax slab, if they are coming into a debt mutual fund, the indexation benefit will play a very, very important role post-tax returns when compared to the traditional investment, where they'll be taxed at 20 or 30%, where with indexation, as Kausav has explained. So the post-tax returns on this will play definitely a good alpha on the overall portfolio. So that is one. And second thing, answer to his question is, over a period of time, if he is going to be stay put invested, so I'm very sure they can get an alpha over the traditional investments.
So there's a nice question from Hitesh Arora. Kaustubh, I'd like you to take it. He's saying, for conservative hybrid funds, are there any limits on the amount of concentration they can take to each bond in the debt portfolio? This concentration has been an issue with debt funds. So is there a rule actually for hybrid funds also on how they concentrate their debt portfolios?
So there is a concentration, obviously a per security concentration that exists, 10%, but beyond that, there's nothing in terms of credit risk buckets or anything of sorts. So I mean, it's a broad-based thing for all sort of funds, and obviously there are limits for each category as SEBI's defined it, but no specific credit buckets that have been defined. And that's why I said, when you look at categories where there's not necessarily a definition of credit or interest rate buckets, you need to look at how each manager is individually managing that over a period of time.
Right. So Ashish Mishra is asking, in the present scenario where interest rates are going down, which hybrid funds can provide less volatility? What do you think, Harish?
The first one, the conservative hybrid would be relatively less volatile, because their 75 to 90% is debt. That is a base product in the conservative hybrid. In the hybrid category, it starts with that. Okay. Which is a 75 to 90% is on debt. So debt being relatively and more of an accrual kind of a strategy, so that can be relatively less volatile. So obviously it has its own interest rate risk as well as the equity risk. On the volatility part, that's the reason I showed a risk adjusted return also. In the tabular column, the first 2-3 tables were having a relatively less risk and relatively moderate returns.
Right. So there's a comment from Lena who's saying that these fund categories and characteristics are changing so often, it's very difficult to keep track. It's just a comment. I'd just like to say that after the recategorization exercise, I think funds are actually fitting more closely into their mandates and categories. So perhaps into the future, you may not need to worry so much about the flux in the categories and the mandates.
So in fact, that's the reason, Aarti, I've just put that slide on SEBI categorization itself.
Correct.
It's clearly about, in the hybrid, it's only 7 different schemes. So,
Correct.
into number of AMCs, what are the AMCs, mutual funds, and so on. So one AMC can have only one product on that respective category. That's all.
Right. So Balakumar wants to know which categories of hybrid funds are useful for senior citizens. Kaustup, would you like to take this?
Sure. So, again, it is, typically people tend to think that senior citizens, less risky would be the ideal way to go. But I have a slightly different take on it. It completely depends on the investor's, needs for, if an investor, and I'll give you an example, if he needs, say, a monthly income out of that, and we spoke about that during, our discussion, that then he wants to go into the more conservative categories or even the sort of fixed income fund categories because he wants to generate a certainty of income coming in from that. But if it's someone who's already saved enough for retirement, probably wants to only use a part of that to meet probably either as a pensioner or doesn't really need the monthly expenses from it, then he can actually build I would say a moderately aggressive portfolio because his financial situation allows him to do that. So he can actually leave a legacy back for his heirs in terms of a large well-growth portfolio and only keep a certain amount aside depending on say for medical emergencies or other emergency funds into the more conservative category. So it's really dependent on the financial situation of that individual. But yeah, I mean, I think the common sensical or the intuitive approach would be if you want monthly income, go for the more conservative sort of categories or the fixed income categories, which will generate that return, less volatile return for you.
Yeah, I just want to add to Kaustubh's point. So there are options which is called SWP option, which is there, systematic withdrawal plan. You just put some X amount of money so that money will get withdrawn from the respective hybrid fund and the money goes back to the customer account. That's one. And second thing is technically being a senior citizen with a lot of tax concession is on, above 80 year plus, and a lot of, taxations are there, taxation concessions are there. Technically, if a customer is at a 0% or a 10% tax slab, okay, this works really beautifully. SWP option by investing into mutual fund debt schemes actually works relatively better for them.
That's right. So last question, over what time horizon must we compare hybrid fund performance? Devendra is asking. So I think we discussed this at the beginning, right? Because certain funds are suitable for more short-term horizons and certain funds are more suitable for long-term ones, right?
Yeah, that's right. And basically what you want to be doing is kind of, matching your investment horizon with the product type.
Correct.
Rather, and so you would obviously want to look at the construct of each fund within its peer group rather than across the peer groups and compare performance in the context of that peer group rather than across the categories that exist.
Right. So I think we've really gone on for long. So though there are other questions, we unfortunately have to close now. Thanks a lot, Kaustubh and Haresh, for making it a very lively session. And I apologize for the technical glitches, which led to a little bit of confusion at the beginning. I hope you all enjoyed it and were able to take away very useful tips on hybrid funds from this session. Thank you so much for being with us.
Thanks,
Thank you.
Arvind.
Thanks.
Haresh.
Yeah. Thank you.